Okay, hope I will not fall asleep. And I'm sure, well, I can't afford to fall asleep, but then you guys can. But let me see how best I could survive. Okay, your topic is, I'll share the screen now. Share screen. Okay, can you all see the screen? All of you?
Yes, sir.
Okay, right. Well, it's a pretty hot topic nowadays. Beside your examination, I'm sure this is going to be something relevant to life as well, because we have so many issues, so many discussions going on, and it's all about the economy. And the issues are quite overwhelming, and it's going to be quite challenging as well. So our topic is macroeconomy, policy, and development challenges. So I give it a real life excursion to macroeconomics, Sri Lanka's challenges in perspective. So this is just to get a hang of exposure to economics. Are there people who have done economics at some stage? Other than for you as a part-time subject or something? Other people? Sanjeev, one more thing. Hello. Sanjeev, make a record කරනවද මොකද්ද වෙන්නේ? ඔගොල්ලෝ record කරනවනේ. හරි. Okay. Right, so that is also resolved. So macroeconomy, policy, and development challenges. Now, let's first peep into some of the materials that are circulating. Now, this was about the macroeconomic forecast, which was given in March 2020 by the IMF. So they basically say Sri Lankan economy remains vulnerable to shocks, public debt, refinancing needs, and what are called external buffers, meaning we don't have much of a shock. There are shock buffers from the external. External means outside Sri Lanka. Then there are issues like the public debt in specifically, which is on a high level. Now, public debt here, as you know, public debt is what the government has borrowed from whatever the sources. So in that also you will have local debt and foreign debt. As you know, I think on the 2nd, that was yesterday, I think, they paid the 1 billion debt resettlement. So that's a major thing. So then we go to Asian Development Outlook 2020 update. And their forecast is also not only to us, for everybody else, looking rather bleak. Economic prospects in developing Asia have worsened. GDP forecast have been downgraded. Maybe we don't know what GDP is, some of you. Well, in very simple Simon terms, GDP is the amount of output of a country, the value of output. So if you value the output of a country in a year, we call it GDP, gross domestic product. And so if the GDP is expanding rapidly, it's good. If the GDP is not expanding fast enough, concern. If the GDP is contracting, pretty bad. Here you are. The ADB says in 2020, GDP in the entire Asia region is contracting by 1%. That's a big deal. Why? Because Asia was the driver of the global economy. When everybody else was struggling, Asia was doing quite well. So if the Asia is struggling, that means everybody else is in serious condition. In 2021, they say there's a recovery about 7%, but then these are all forecast figures that may happen, may not happen. It depends on how fast the global system is going to recover. Then on the same side, the other side of the coin, the industrialized countries, the rich countries are also going to contract by about 0.5%. And they are expected to make a bounce back in next year, 7.5%. So again, it's a forecast. Then they also say that the problem is the COVID. We all know COVID has been playing havoc in literally everything, our social lives, economic lives, and our health-wise. So the threat of COVID is going to be the deciding factor. We still don't know where things are moving. So the latest hit to this COVID pandemic is the world's superpower and the super guy is infected. So that's not a very great scenario. So that really shows the amount of penetration COVID has made in some of the most advanced countries. Then on the other side of it is, we are just next to a giant, India. India is having a rampage in COVID. Their death rate is now, the total death is more than 100,000. So they are reaching 5 million of infections. That's a massive toll. So these are some of the major aspects of COVID. The problem with COVID is COVID tells you to do exactly opposite of what economists tell to do. Economists tell engage, trade, buy, hang about, go through many things, shop, you name it. COVID says just the opposite. Don't do that. Social distancing. Don't go to shops. Don't go to cinemas. So as you can see, the challenge humans are facing at the moment with regard to COVID, and it's going to go away in a hurry as well. On top of that, the COVID also affected a cloud layer in the global system. I call it finances. The production, real economy is where we are at the ground level, the real action. So that is affected. But then what is getting more magnified with this thing is the expectation. The financial markets are in utter turmoil. They are really trying to salvage situations, but there's no end in sight. So things are looking quite bad to the status quo, the way that we used to live. And also it is hitting the poor more than the rich. Then comes to the specifics, the South Asia prospects. Indian economy is going to contract by 9%. That's a massive toll. And they say it will recover by 8%. Now, you see, we might say, oh, right, it is going to come back by 8% in the next year. Doesn't make as dangerous as a 9% drop. The reason is 8% of that contracted economy. So basically your increase will be much less. And as a result, the 8% in effect from current terms could be even less than 5%. Then coming to Sri Lanka, we are in a pretty precarious situation. We are, and Maldives, for example, we are depending on activities which are the antithesis to COVID, tourism. So we don't have tourism in sight, and the whole lot of investment that we have put in there are just idling. It's a massive economic blow, massive social, massive psychological. It has put a lot of people's lives upside down. Then countries like Maldives is going to get really hammered because their entire economy is on tourism, whereas we are a little better. Then there are other countries which are not so much relying on tourism, seem to have been affected much less. Bangladesh, Bhutan, Nepal. So their impact is not at the core, but at the tail end. So there seem to be some kind of a breathing space for them. Now this is Sri Lanka's growth forecast. As you could see here, Sri Lanka was reeling from some very, very bad economic growth targets. 2008, 3.5% or less than 3.5%, just around 3%. And 2019, before COVID, less than 3%, one of the worst in recent history. Then 2020 is a massive 5.5% decline. So it all depends on this 5.5% can be even more if the second half of the economic growth did not sustain. At the moment, we know the first half was really, really bad. So the second half must compensate for the first one as well. So its forecast 5.5% is pretty modest. Then 2021 said 4.1%. That means things are going to be not so bad. Forget about the figures, not so bad, but not so great either. So that's as I said in the same way. So 4.1% is roughly around 3.5%, because the 4.1% of a contracted economy. Look at the we compare ourselves against each other, the pack, South Asian pack, where we are pretty badly placed. We are fourth from the bottom. Well, Maldives is an exceptional case. Take that out. So India, and we are just about India. Of course, India is still reeling from COVID. So in that respect, Sri Lanka is a little better. But the economic statistics are not converting that success. It doesn't seem to be converting that success yet. Then consider Bangladesh is doing pretty well, 2020. That's pretty amazing. Bangladesh, Bhutan, and Nepal, while everybody else, India was doing quite badly as well, 9%. So these statistics tell us a story. Let's try to understand a little more what kind of story this depicts. Then we go to the next one. This is another common statistic we come across called inflation. Now, inflation by Sri Lanka is not bad. We are among the best inflation categories. In fact, we are at the third level, whereas Pakistan are doing extremely high inflation. And India is also not so good, because for India, 4.5% inflation is pretty high. Sri Lanka has been used to higher inflation, but now we are on a more low inflation phase. So therefore, 4.5% doesn't pose a serious problem. Now comes to what we call dollar balance. We call it current account balance. That means how much of money coming in, how much of money going out in terms of business transactions, not borrowings. So as you could see here, Maldives and Bhutan, which are small countries, are pretty badly affected by, that means they're running a huge hole in their dollar balances. Afghanistan, for some strange reasons, are doing good. Now, Sri Lanka's situation is 2.4%, so which is not a very healthy one, because what it means is 2.4% of GDP, meaning we have our GDP is around 84 billion US dollars. Let's approximate it to 100 billion. If you put 100 billion, we are short of $2.4 billion in the current account. That's a pretty huge toll to deal with. When you come to the more detailed analysis of some of the close-ups, we have some internally this time, not externally, is that we have some state-owned enterprises which are pretty debt-ridden. So they are, when they make losses, government had to bail them out, which is costing us another 1.5% on GDP. So that should have been avoided. That was pure mismanagement. Then external debt, which is basically the borrowing from outside Sri Lanka, is 59%. Then there is another statistic, it says, look, we have to pay back our external debt by two means. Either we earn and pay back, which is the best one, or you borrow and pay back. Now, currently, we are not in a position to earn and pay back because our earnings are pretty meager. So therefore, we have to borrow. So the question at the moment is, when you put the amount of debt we have and the amount of earnings we make, we are almost 3 times, 2.5 times. That's quite a huge burden for a country to deal with. Then, the overall government borrowings have gone up, which has now reached almost about 90%. So these are the stories we get. What do we make out of it? So our task is to get some sense and some bearings, some references, some toolkits. So I'm now going to start the more structured school session, I would say. So our discussion is about macroeconomics, and we probably know economics, but macroeconomics is, what is it? Macroeconomics is the big picture. It's not about markets. It's not about stock market. It's not about some big companies, whether they are doing well. It's about the whole thing, the entire family. So we are looking at the macroeconomy. We deal with a different kind of toolkits. We're looking at what we call inflation. For that, we use consumer price index. We look at the health of the economy, how rigorous, how active. That's called GDP, gross domestic product. Then also we look at how many people are employed and how many people are unemployed. Unemployed is a major issue, so that's another one. Then standard of living, how people's living has changed. Then for a country to make money, especially dollars, you need to export. So the exports, on the same breath, we can say, if we are relying heavily on imports, we will definitely be in very serious complications. Then the last is inequality. Now, inequality in Sri Lankan context is very much an issue. We have had civil wars. Civil wars were entrenched in the issue of inequality. People say, look, we are not getting our share. And as a result, they rebel against the system. It's very destructive. LTT, we might say, well, these are all ethnically driven. That's one explanation. But how do you rally people behind your slogan is primarily how much you have got your share of the economy. Then when it comes to macroeconomy, in addition to the tangible things we look at, specific data, there's something that is in the atmosphere. We call it money. Now, you might say money is tangible. Money is tangible, all right. But money, in its intrinsic sense, makes no sense. Because having money without goods is money is as good as a piece of paper that could go to the dustbin. So money, but then macroeconomic sense, we say money looks pretty harmless, but the money can derail a balance between what you call real economy and the nominal economy, or as we call the day-to-day things we do. Now, okay, so we agree that there is something called macroeconomy. Macroeconomy we look at from an aggregate point of view, a broad point of view, and then also we said in the discussion we have money. So money is normally handled by central bank because of the reason central bank is not a guy who expends. Government is a guy who spends. So in order to separate the two interests, central banks are empowered to control money and issue money. So as a result, it's like this. You have somebody at home who is the most frivolous spender. You give him the cash box. So, and all the assets you have. So that means that is the disaster one can imagine. So it's the same way, government is a spender. So therefore, a new individual institution is created that's called central bank, and the central bank is supposedly controls the money and money-related activities. Then macroeconomy also is driven by some goals. What are their goals? Their goals are creating employment. Their goals are managing inflation. Their goals are promoting economic growth. Their goals are keeping our dollar account, or we call balance of payment, in a healthy situation. Now, the irony is, if you try to deal with inflation, you're going to affect economic growth. You are going to affect employment. If you try to promote economic growth, then you might get inflation. You might get balance of payment problem. So it is very important, macroeconomists, to understand there's no straitjacket, there's no highway where you can simply get to your target without any other interruptions. There are many, many challenges in between. Then another point about macroeconomy is when something happens somewhere in the world, and with the present globalization, everybody is interconnected. So as a result, you find that you don't have the peace of mind or peace of space to do things the way you want. When you do something in Sri Lanka, for example, there are many guys outside will be talking about it. So as a result, you find your situation is getting very precarious, sometimes untenable as well because of the global system. So the global system, on the other hand, is connected through financial markets, stock markets, trade, investment. There are so many things that cut across the global social system. So this slide is trying to explain how much each and everyone is getting affected due to each and everyone's conduct. There's another point about macroeconomy. Macroeconomy is always going in cycles. It's hills, declines, valleys, hills, declines, valleys. So basically it goes in what we call cycle. Now, what is our worry? Do we worry about cycles? Yes, of course. Because if you can see here, and if you can see here, it's on a rise. A rise means everybody is very bullish, everybody is happy, investors are going for investments, people are borrowing, and jobs are getting created, production is going up. So it's quite a nice area. But then when things go too far, it has to do the opposite. So what happens here is that every point there is some kind of intervention or policy is in place in order to manage it. So when things are contracting, businesses are closing down, jobs are becoming more and more scarce, and as a result, the economy is getting contracted. So normally going up is good, going down is good, down is bad, but that's a way of life. So normally macroeconomics argue economies are always in this kind of cyclical movement, and those cyclical movements do require state interventions of different kinds. And one cycle is called business cycle. What you see here is a forecast of business cycles, not forecast, the realistic of business cycles for two countries. One is US, the other is Sri Lanka. So as you could see here, the fluctuations are very much significant. But what is most critical here is that business cycles, if you happen to be on the up cycle, you're good. If you happen to be on the down cycle, you may be having problems. Okay, so now basically we understood that macroeconomics is important and what macroeconomics is and what are the issues we come across, and some characteristics like the business cycles. Now what I'm going to take you now is, okay, as general professionals and experts, how do you dissect an economy? So for the dissection, we have economic indicators. Now economic indicators means you're taking data from the economy in different baskets. Take for example production. So production of some vegetable or something. So the production of vegetable is carried out under certain circumstances, but it will give data. So you put those physical production into one category. Then the second category is price data, meaning inflation. Now, inflation is measured almost professionally, and as a result, inflation data are generally available much faster than any other set of data. So the fiscal policy is also called budgetary policy because it's a budget of the country, of the budget of a particular locality. So it's called budget policy. And then there are also kind of policies where central bank does. They are called monetary policy. Monetary policies are basically to manage interest rates, manage credit. So it's at a more intermediate level, but there is quite a bit of request and demand for such policy interventions. So then there is another thing about outside these main lines, that is the trade and industrial policy. Now, trade and industrial policy is of particular significance because a lot of countries that succeeded had high level of trade and trade and industry. So this trade and industry policies are cutting into a number of areas. Trade and industry policy, even then cutting into trade and industry policy is cutting into the real economy. And the trade and industry is basically tell us how some of the major industries are doing well. For example, garments coming under trade and industry. Then the one before the last, balance of payment. Balance of payment is how do you manage the whole dollar balances, including this one. So the balance of payment can be pretty nasty. If you don't handle it right, if you don't anticipate it right, the balance of payment can derail you completely. And then in a rush, you cannot find solutions to balance of payment. Normally, balance of payment issues are referred to it's the country's international wealth net. Right. So that's where we have a broad outlook on economic indicators. But then there are other more detailed ones, rate of growth of GDP, per capita. If you don't know, we'll come to them later. Unemployment, inflation, domestic payment, savings, national investments, economic structure, and capital output ratio. So all these different indicators employ different kinds of techniques and different kinds of material. Then when it comes to economic indicators, there are other guys as well. Budget, government budget, and also it's important revenue as a percentage, the growth of public debt. Those are some of the key indicators that will create an assessment of the country concerned. Then there is another one which is called terms of trade. And the terms of trade is what happened to our prices of exports in comparison to prices of imports. So You basically divide the price of exports by price of imports and multiply by 100, you get terms of trade. Now that terms of trade means if you are a smart country, you'll be exporting less, but you'll be able to buy more uh, without burdening your balance of payment. So terms of trade is basically to help each other. Uh, prices and the export prices and import prices are comparatively looked at. So in case of Sri Lanka, terms of trade has been not so great because our prices have been either staying flat or coming down. On the other side of the terms of trade, this example is oil prices have not gone up. Therefore, impact on terms of trade by oil is not very much driving. So these are some of the benefits at the moment. Then the last in that is the external reserves. When you have enough dollars, what you do, you set aside a certain amount of dollars in a safe place. That safe safe deposit of dollars we call external reserves. When you're saving, your intention is not to use it within a short period of time. So that gives you external reserves to boost up if you manage it well. At the moment, the current government boast of external reserves have been upped by certain percentage. Okay, so external reserves are very much important. Give me a second. I need to get a glass of water. Give me a second. I'm back. Okay, so these are other indicators when we look at the macroeconomy, trying to understand, okay, from a longer term perspective. Then So these are called social indicators. From a Sri Lankan point of view, we are doing social indicators generally better than many other comparable countries. But that's becoming also coming under some kind of pressure because we need resources to keep these things up. Now, countries like US have social indicators very poor. One of the explanations for that is US is a country that has not been spending a lot on social indicators as much as countries like comparable countries like European countries, which are doing pretty high level. Then another set of indicators we use is these are new things, but not so much not so much economically relevant, because a lot of these things sometimes economically are not very helpful. For example, countries that have developed very rapidly in Asia, for instance, they had sort of basically turned a blind eye to these things because they were very autocratic and they were pushing things, including Singapore, where they have things like human rights have not been a major occupation, transparency. So after some time, these things have become less and less invisible. They were becoming more and more relevant. So as you could see, a list of these things like corruption are some of the issues that even a country like Sri Lanka is to grapple with. So one asks the question with the present, this situation of 20A amendment to the Constitution. On the one side is, one group says that, okay, we need power centralized so that you can push for changes. Then the other side of the argument is that if you allow these things to go on like that, what happens is you will have it could be quite damaging as people talk. So as we see that give me a second, my internet. My internet is getting a little wibbly wobbly. Give me a minute, I'm trying to fix it. Okay, so then there are other ways of looking at macroeconomy, that is by looking them from which end the economic the indicators are looking up. So we were looking at the outcome indicators, but then the other side of the economic indicators is you should be looking at input indicators, meaning what are the things that have to be in place. So things, the argued ones are investment. Sri Lanka must be doing sufficient investment. Sri Lanka must be doing savings, etc. Right. Now, then we come to macroeconomics. Sometimes even the GDP, for instance, we say GDP is the value of the output of the country. But then you might also look at GDP in components. Say, for example, you might look at GDP in agriculture. You might look at GDP in industry, because these each of these segments are working differently. So when you understand the individual pieces of the GDP, you can understand the GDP itself. So then there are other issues which are sub-issues. So like that we have. Then these are some of the qualitative indicators that we use in the discussion of GDP and economic well-being. Things like transparency, accountability, non-discrimination, equity, inclusivity, participation. I think some of these things are reflected in the debate that is going on in the parliament. Okay, so what we did in these brown slides is that we were trying to get some hang of the kind of data and the kind of indicators that are in use. Then now what I do is we will be seeing these pieces here and there when we talk of the economy. Then I come to government policy. Government policy is what government does to influence the economy. So there are other policies as well. For example, more recently government said, okay, this lane rule in traffic, that's a policy. But that policy is not to influence the economy, but the social behavior. But it does connect to the economy in a long shot. Why? Because if people are disciplined, people spend less time on the road, that means it is beneficial to the economy. So having said that, we can look at some of the specific baskets of economic interventions by the government. Fiscal policy. Now, fiscal policy is the budgetary policy, and which is something a lot of people at least pay attention to, because it affects us directly. Say, for example, taxation. Then what government spends on various things. Then infrastructure. When the budget comes, there is quite a bit of excitement about budget deficit, how the budget is financed. So this deficit to finance. So these are all bits and pieces that we pay attention to in the discussion of government policy. Then another set of policies are called monetary policy. Now the monetary policy is, by the way, fiscal policy is generally, not generally, primarily handled by the treasury of the government. And the fiscal policy area is what politicians are also craving for, because that's where the cash is being spent. And that's where government undertakes all kinds of expenditures, useful or sometimes even extravagant. Monetary policy is more of a passive policy. In a sense, monetary policy is persuading people rather than directly influencing people. How? Monetary policy can be keeping the interest rates down. Now I was just reading newspapers. It says central bank is trying their best to bring the interest rates down. So that is monetary policy. So they can't simply say, okay, bring the interest rates are going to be such and such. No, it doesn't work. What they do is they try to work through the market and try to bring the interest rates down or interest rates up. Now, in the case of interest rates up, there are devices central bank has. They can raise interest rates of the funds that they lend to commercial banks, or they can buy or sell treasury bills, and thereby they can keep the interest rates up or down. Then there is this government, central bank can say reserve ratio. Reserve ratio is every time 100 rupees is saved and in a bank, that is the capital the bank has to lend out to borrowers. So bank doesn't create its own capital. So they get somebody else's money and lend out to someone else. So because of that, there is a rule which says if you take 100 rupees as a deposit, you can't give out 100 rupees as a loan. All what you can do is you can give up to a point where the reserve ratios decide how much lending you can give. So if government central bank policy is 10%, so which means you spend, you get a deposit of 100 rupees, and you can give a loan up to 90 rupees. You keep 10. That 10 is called reserve ratio. So here 10% is a reserve ratio. If the government central bank decides, okay, we're going to increase the reserve ratio, so which is de facto saying banks have to bear the extra cost. So banks, what the banks do is, as a result, they increase the interest rate. So the interest rates can go up because of these things. So these are the monetary policy, and monetary policy also comes alongside exchange rate. We know exchange rate has been going up quite rapidly last year, but now the exchange rate remains around 183, 84. So that means the exchange rate is managed by the central bank to keep it at a steady level. Then in addition, we will have policies which are targeting specific sectors. One such policy is industrial policy. Same way you might have agricultural policy. Same way you may have IT policy. So there are sub areas, but basically it is about measures, incentives, targeting a particular segment. So very often these policies are used to drive those sectors into high growth sectors. Then there's another set of policies are called trade policies. Trade policies are basically to decide what kind of transactions we can do with the rest of the world. Now, trade policies are not about buying somebody buying from double the market and selling in Colombo. That's not it's a trade, but we don't call it a trade policy. Here, the trade policies are basically about imports and exports. So exports normally don't go through a lot of policy, whereas imports, as you know, yesterday I was at a conference, and I was sitting next to one of the largest car importers, and he was telling me they can't import cars till 2022. So the trade policy appears to be, at the moment, cars had to be curtailed to a very large extent. So that, whether it is good or bad, is a different thing, but that's a trade policy. Then another one is President says that we are going to renegotiate free trade agreements. Now, free trade agreements are trade policies. Free trade agreements are a specific limited arrangement to say that we will allow certain things to be under free, certain things to be under taxes, and these are very high taxed segments, so on and so forth. So there are trade policies are basically to decide what is allowed to come in and at what price. Well, the exchange rate policy usually is supposed to be market driven, the amount of dollars and rupees in the market. So as a result, exchange rate policy, but then that's not the way it goes. Those who have done macroeconomics, now this is a demand curve, this is a supply curve. Let's say this is dollars. So exchange rate policies, you can, now this is the exchange rate price you are happy with. But then for some reason, if there is more demand for dollars, then what happens is exchange rate goes up to a higher level. When the exchange rate goes up to a higher level, that means exchange rate has depreciated. Sri Lankan exchange rate has depreciated. Some other exchange rate has, the US dollar has appreciated, right? So what sometimes the central bank does is central bank will release, they have some dollars with them, they could release to the market, so thereby exchange rate is stabilized at a particular level. So this is how you manage the exchange rates in a bank system. Then the last is the development policy. Development policy is that what kind of policies government adopt to help the poor, bridge the income gap, and creating development in rural and regional areas, eliminating economic imbalance between developed and developing. So like that, there are so many segments that can come in there. So coming to the specifics of fiscal policy, which is one of the major policy areas we normally come across. The challenges are we have a rising expenditure, our tax revenue is not rising, or if at all it's falling. So that means our budget deficit, revenue minus expenditure, is ever expanding. So that's quite a large responsibility when it comes to fiscal policy. Then the fiscal policy also pay attention to social welfare. That is why during COVID time, government decides to pay people some dole to help their living. So these are social welfare that comes from the fiscal policy. Then we have the issue of past liabilities, meaning debt servicing. That's precisely we are currently up against. Debt servicing is basically paying the interest and paying up the loan installments. And we know that we borrow money from banks, they charge you interest and the installment basis for settling the loan. So debt servicing is basically that. Then another challenge in the fiscal policy is very often you forecast for something, you end up with a much higher value. In some cases, you end up with a much lower value. So these kind of values can be quite distorting, and as a result, forecasts are challenging, but forecasts are also important. So all these things, depending on the way they operate, can have implications on private investments, debt, and other economic parameters. So, okay, so we discussed with budget in a simplistic sense. Next, we can discuss the BOP, the balance of payment. Usually, the balance of payment has two levels. One is called exports minus imports. That's called trade balance. Then to that we add, say, remittances, which call services, not services, transfers, trade balance, transfers, and then we will have, so with all that we get what we call current account, and then we have the loans, etc. Then we get BOP. Then we get BOP. So the BOP is the broad picture, but BOP is primarily driven by the mismatch in the exports minus imports. The export minus imports on average is around 11 billion. So it's a massive gap in our lifetime. So the only way we could do it is either we have to promote exports or we have to cut down on non-essential imports. The current government claims they are doing both. One is they are suggesting that the unwanted expenditures are curtailed and we are doing exports in the non-traditional areas. So it looks some hope, but it can get derailed in pretty fast as well. So the challenges we have in the BOP is export growth. We have a pretty mediocre export growth. And the second is our exports are coming from one or two sectors. So it is diversification is much less. And thirdly, capital flows. The capital flows are the ones that have to be paid on account of loans and etc. etc. So capital flows will bring cash, so which will stabilize the economy in the money front. But the trouble is that stabilization comes at a price, because we have to borrow from others if we don't make enough exports. Something very peculiar about BOP is, unlike any other economic things, these can happen pretty quickly, very, very quickly. In the blink of an eye, it can happen. And next, what can happen is it will drag other areas like exchange rate, capital flight. Capital flight is people are taking the capital out of a country, and so these are all affecting the seriousness of the BOP issue. And the trouble is, unlike any other issue, you cannot shove it under the carpet, because you're dealing with outsiders to the system itself. Then, although we spoke about the two as two separate entities, they are interwoven. They are quite closely related, either as inputs or as outputs. Let's see a few of them. Now, if the fiscal decides to have a deficit, it has to be financed. So when it has to be financed, it has to borrow. It has to borrow. So the borrowings are going to go up if you have a problem of fiscal deficit. Then government can create money. We call money created. And so this money, some believe this money can cause inflation. So at the moment, we don't have inflation, so it's not a serious problem at the moment. Then if the government borrows money from the local market instead of printing, they will say, look, there are a lot of money circulating, and so they want to flush out those money. Then what happens is that I was here. One of the fallouts of printing money is it can put pressure on the exchange rate. Why? Because you don't have enough dollars coming in, but you have a lot of rupees printed. So at some point, you decide that exchange rate is going to come under pressure if you print a lot of money. If you have high interest rates, so that means it's supposedly not so great for investments. The cost of finance is going to be quite high. So that is a possibility for investment cost to go up. So when the investment costs go up, investments are getting affected. When the investments are getting affected, factories are not getting opened. When the factories are not getting opened, that means this the whole cycle is going to break down. But then the other side of it is that deficits can be taken for granted, and as a result, people will just ignore budget deficits, for instance, because the impact of it is going to feel much later. Then, so those are some of the aspects of issues in fiscal monetary policy, and they are interconnected with other parameters. The government fiscal policy can have very direct impact on the BOP. How? One is, if the government is spending a lot of money, that means there will be quite a bit of heavy import content in the imports. If the government is a large importer, large consumer, in fact, it's the largest consumer. So what it does is it will create the impact on the imports area. Then whether the government expenditure can affect BOP, well, in a roundabout way, because BOP is getting affected if there are dollar purchases going to take place. So fiscal policy, frivolous fiscal policy can be somewhat risky. Then at the same time, sometimes if the government borrows money from abroad, and that can, in the current terms, that can stabilize interest rates, that can stabilize dollar rates. But on the other hand, if the government interventions are short term, and especially with the short term borrowings, then that's a wrong side of the path. Now let's look at some of the specific government interventions on growth. Very often growth is supported by government itself. You give a lot of incentives, a lot of support, and etc. But currently, once the pandemic situation is brought under control, there will be you will be able to spend more expenditure and promote more and more economic activities. But people argue the government intervention has not been well focused, and that might affect the overall outcomes. So what would the government be looking forward to keep the economy in some kind of a stable situation? You would like to have a low inflation. Now, this is a kind of an anecdote you can think of. You must have seen cars parked on the shoulder on the highway because there was overheating. So countries can also get into overheating, and heating we call in economic jargon inflation. So government is quite committed to having inflation controlled to a management level. Then also the exchange rate. In the case of exchange rate, it is double-edged, because exchange rate, if the exchange rate, Sri Lankan exchange rate is not showing the amount that it should be having, then the exchange rate can be unfavorable to some. Now, if the exchange rate, rupee exchange rate is fixed at 150 from 180 odd, then what happens is imports will galore to the country, because exchange rate is encouraging people to buy from outside, and exports will be affected, because exports will become more expensive to the recipients of the okay. So now fiscal policy again can come what we call as a stimulus package or austerity measures. Stimulus is the opposite of austerity. Stimulus means that basically controlling and managing the government budget. Then fiscal policy also can be used to promote economic growth by encouraging investors to make investments. So for that, you have been promoting things like tax holidays to promote FDI. And the fiscal policy has another important role, is the structural, infrastructure. So even we were mentioning about state-owned enterprises. Now these state-owned enterprises are coming under fiscal policy commitments. Now fiscal policy in technical perspective, fiscal policy is government taxes. Primarily the revenue comes from government taxes. And the second is government expenditure. Government expenditure is how much of expenditure government is going to undertake. Right. Okay. I'm not going to details there because it's there in the latter slide. One thing to remember is that the difference between government revenue and government expenditure called deficit. And deficit is a pretty common thing in almost every country. And but what is really problematic is, do you allow the deficit to expand? That's called expansionary policy. Or do you contract the deficit policy to contract? So that's called contractionary policy. So you will have this kind of terminology being used time to time. So this is a cartoon about how politicians are so hell-bent on spending, government expenditure. So government expenditure can come in all different shapes and colors. So government expenditure can come in workers' salaries, imports, and everything. So there is government expenditure is very much interwoven with our day-to-day lives as well. Then the government revenue side, this is on a slippery slope. Why? All the sources of income, primary sources of income in the government are listed here. Income tax, corporate tax, pay tax, then sales tax, VAT, then trade taxes, customs duty, Then there are other taxes called excise taxes. Then there is non-tax revenues, not so important, but needs to understand. Non-tax revenues are government invest in some properties, and those investments pay off. Then there can be fees and levies by the government. For example, we pay excise duty, we pay uh, various other things on liquids. So these are sales taxes. Then there is taxes coming in. Non-tax revenues are licensing fees, etc., etc. So those are the basic breakdown of the government revenue. So when it comes to the specifics of those revenue measures, some revenue measures are superior to others. For example, direct taxes are said to be superior to indirect taxes in terms of quality. That means the direct taxes are managed well, and they are components wise: income taxes, pay taxes, corporate taxes. Those are the taxes there. Then the indirect taxes, on the other hand, are what we call regressive taxes, meaning it affects different people differently, and very often poor people are affected in a very bad way. So therefore, indirect taxes tend to be regressive, and but they are very much in our agenda as well. Revenue. Yeah, so there is this division between, divisions between revenue, taxes and non-tax, current expenditure, current deficit, surplus and public savings, and capital expenditures, budget surplus and deficit, and how the financing is taking place. Government can borrow from the bank, central bank, or government can borrow from uh, public or even local institutions. So these are all coming under how the government deficit or the surplus gets created. Then deficit financing is also attracting foreigners, because when the government issues sovereign bonds, these sovereign bonds come from other countries. So as a result, there are various things that can come into the deficit financing. In the case of deficit financing, we often have maybe at least three types: concessional, institutional, and foreign market borrowings. There was a time where we used to be very much on concessional borrowings. That was when we are a very poor country, and our per capita is less than $1,000. That's correct. Institutional borrowings are, you're borrowing from the ADB, World Bank. Now, here again, when we graduate ourselves to a higher level of income, you seem to lose the capacity to be able to manage things as an alternative challenge. Now, then government can borrow from institutions, like for example, even the central bank, commercial banks, and various other institutions they can borrow. Then other area of foreign financing is government or even private sector goes to the foreign financial markets and promote and get funding. In the case of domestic market sources, there's treasury bills, bonds. Non-market sources are uh, rupee securities, meaning rupee securities are not sold in the market. It is basically buying direct from the sellers. Then there is a more controversial thing is bank financing. If you bank finance the budget deficit, some argue that it can cause more money supply and as a result, inflation. But then there are other people who argue that bank financing could be very helpful because the bank financing can keep the interest rates at a certain manageable level. So these are some of the implications if we borrow from the on account of deficit financing. Now, if you borrow from local market, it can, some argue it can pressurize interest rates because the government is the largest borrower. Then the other thing is, if money supply has been increased, some argue that inflation can creep in because there will be more and more free money available in the economy. Give me a second, I seem to have a problem in my line. Let me just quickly fix it. I will, for a moment, I'll go off the air. Give me a minute, I'll come in a second. Are you receiving me well? Hi. Hi. Can I have a feedback? Hello. Do you hear me well?
Yes, sir.
All right. Okay. Sorry. Right. So I was talking about the deficit financing. Now, deficit financing is that how do you finance the budget deficit? Now, that has different implications, as I mentioned to you. If you use domestic resources to finance, especially it used to be the case in the past. I'm talking about 15 years ago. Government borrow directly from insurance corporation and other places. Then it doesn't affect the market very much. But then in the case of in the 90s and late 90s and since then, we moved to what we call borrowing from the market. So borrowing from the market means that we use treasury bills, and the treasury bills tend to be short term. So when you are in the short term borrowing, you have a problem of pressurizing the interest rate. So that's why we had quite a high interest rate value in the 90s. Then when it came to Mahinda Rajapaksa regime in the 2000s, they moved to more and more long-term borrowings. And so domestic long-term borrowings, which had been the bonds, and the bonds allowed the government to bring the interest rates down and to have control on inflationary front. At the moment, we are our borrowings are very much bonds. Now, you remember in 2015 the so-called famous bond scam, again with regard to 25-year bonds. But priorly, it was just 1 year treasury bills, which was very problematic because you spend on long-term expenditures with short-term borrowings. We know that if you buy a car with your credit card, how it affects you. And there's another domestic thing is what we call borrowing from the central bank. When you borrow from the central bank, we call it printing of money, because when you borrow from central bank, you always bring in new cash into the system. So new cash into the system, some argue, say that it will allow the government to keep the interest rates low, but it can cause inflation to creep in, because they argue that more money chasing few goods. But this argument is not all well received by everybody. There are many who argue that that's not the way it works. So as a result, now you find there are a lot of governments are spending money just by printing. So even this government in the COVID times, there was a lot of borrowings, but which is basically printing. You go to the US, they printed trillions and trillions of dollars to pay up those COVID helping cash. And if you borrow from the foreign money comes in two forms. One is you may get the money from institutions like World Bank, and so they may give you concessionary loans. But Sri Lanka is not in that category anymore, because when we are going up in our per capita income, our borrowing capacity is looked upon from a different perspective. So we don't get what we call concessionary financing, we get more commercial financing. So as a result, our debt is going to be more expensive. Then you may also go to the foreign market and borrow. And if you borrow from the foreign market, that could cause problems, in particular if you borrow short term. Now this happened in 1997 when East Asian crisis took place. It was because there have been a lot of short-term borrowings by Thailand and few other countries. So short-term means you have to pay back it very quickly. Now some people argue even the present debt repayments have been partly due to some kind of short-term commitments we have made, not enough without much breathing space. So this is the case. So now what we did so far was we were trying to take the bits and pieces on the economic policy front and trying to have some understanding. What I'm now going to do is I'm going to look at some of the stories of Sri Lankan economy. Now this is what we call Sri Lankan political story or political economy. Sri Lanka ironically had so many different phases. And some people say that Sri Lanka kept on missing opportunities and never learned. That's partly true, partly not true. Before 1950s, before we got independence, Sri Lanka was one of the best in Asia. In fact, we were one of the richest in South Asia. And we were ahead of countries like South Korea and Thailand. But one major problem we had was we were standing on one foot, that is plantation exports, basically tea. If anything happens to tea, the whole system collapses. That's what it was. So we tried to move out of plantations. 56 to 77 was that effort. In the 56 to 77, we thought, okay, we will go into industrialization, starting factories. So, but unfortunately, these factories were not started by many private sector guys. They were started by the government. But there were some exceptions. For example, Upali Motors, Upali Fiat, they launched one of the first assembled cars in Sri Lanka. But then overall, much of the industrialization was by the government. So we had cement corporation, steel corporation. So there were many things. That was the result of, again, at that time, we had a problem of not having enough dollars. When tea was going down the tube, we were importing a hell of a lot, so we were in dire strait. 77 to 82 was a short period, and there was some economic revival, but at the same time, it brought in what we call civil unrest. And that civil unrest had an upper hand, and it went on till about 2000s. And so 1990, sorry. And 1990s, there was a shift. The government took what is known as engine of growth, and they were hammering exports. And it was this period that Sri Lankan garment sector took the place that tea had. So garment sector currently is the largest exporter with about 7.5 billion worth of exports. Then 1995 to 2005, we kind of took a step back from pure economic development to economic development with human face. In other words, you are not just going on promoting industries or companies, but you are equally promoting how much the poorer people, poor segments of the society gets. Then 2005 to 2014 was Mahinda Rajapaksa regime. That was signifying another situation called infrastructure development. and also the de-escalation of the war in 2009. So it gave Mahinda Rajapaksa regime the opportunity to expand. So which was done fairly well. But then on the other side of that was there were lawlessness and there was corruption becoming a norm. So that led to people to switch gears, switch sides, and move to the opposite side. And that was the beginning of 2014 onwards, the Jahapalaniya, which is basically to manage the economy or manage the government. Those are the slogans, or corruption free. So these are the slogans of Jahapalaniya. But unfortunately, Jahapalaniya did not click the economic button. Jahapalaniya had its own political dialogues, political problems, but never had the delivery of economic growth, which is most fundamental for any country. So what happened was growth came down. There was a lot of inconsistent policies, political turmoil, scandals. Then there was, what they did was they increased tax burdens on people. So there were virtually everybody was paying a sizable portion of tax. So this was the 2019. Then 2020 comes a new regime. So their basically slogan was somewhat modified: people-centric development. And so basically they were trying to talk about two sides. One is where government intervenes and try to sort of help people from a development front. And the other is that to develop the national economic base. So national economic base is national entrepreneurship, local industries, so like that. The people-centric basically means development itself, because the development is people-centric. So I won't go into the details of it. So this is some kind of an explanation on development and growth. Growth is the driver, development is the whole train. Development is what, the power of the driver is important, power of the engine is important, but there must be enough compartments for people to get in and reap the benefits of the engine. So this is what we call, what we could say as development. So in the case of development, we can say growth is the driver, and what is important is how to create the growth. Are we going to go with diesel, or are we going to go with petrol? And if I'm talking about a vehicle, or are we going to go for gas? So like that, means to growth has a major aspect. One of the things many suggest is private sector deemed the main focus. So then, and also there is another thing, whatever the private sector does, whatever the private sector does, it's the government that runs as the gearbox in that engine. Okay, so these are some of the nitty-gritty of growth and development. So I move on here. So basically, present government's policy is productive citizenry, making people more productive, upgrading their skills, IT-based. Then contented family, not so clear. Discipline just for society, still a long way to go. Prosperous nation, hopefully we will. So this is the kind of scenario we have with regard to, I'll take this out. Now I take you through what I call a mini excursion of the economy, Sri Lankan economy. These charts are available on the Central Bank annual report. Let me just take you through some of the ideas here. Look at the first chart. This is chart going up to 2019. So okay. The first chart, as you can see here, the growth is falling down. So growth has been falling down from 2004, 2013, 14, and it was dramatically falling down from 2016 onwards. Now this is a GDP also looked upon from a quarter perspective. Now what happens here is as you can see here, there was a shutdown of economic activity. Now this is where this growth coming from. If you look at it, you can see in 2020 agriculture was pretty badly affected, minus. Industry was affected, not as bad as agriculture, and okay, so here there is another major sector called services, which is occupying more than 50% of the GDP. Give me a second. I'm in a discussion. Can I call you back in 15 minutes? Hello? Okay. Bye. Bye. Sorry. Okay. So these are the three major sectors in the economy. As you can see here, for an economy to do well, each sector must pull together. Here, as you can see here, it has not happened. It has not happened. In 2020, quarterly figures showing that the most recent ones, as you can see here, both industry and agriculture are not doing greatly at the moment. Now, this is another indicator, as we mentioned, the level of living standards, and normally this is basically obtained by GDP dividing by population. So Sri Lanka's per capita GDP growth has been quite significantly rising from 2004 onwards until about 3,821. So that was good. But then it flattens and it falls. 2019 it falls. So that's pretty ironic. Then you come to industrial production. Why industrial production? Normally in an economy, industrial production is one of the most dynamic parts of the economic growth. If the industrial production remains high, so that also shows that the economic growth is going to be supported quite well. So, industrial production has been not so greatly looking, but as you can see here, industrial production has dramatically fallen in 2020 in the first quarter. Now, this is another major chart. As you could see here, unemployment has appeared to have come down here. But then it's rising again. So 2007 to 18, 19, it's rising. Now, part of this reduction in unemployment, which this was coinciding with the Mahinda Rajapaksa regime, is because they absorb quite a bit of people to the state sectors as well. But that's not the way to go about. Poverty levels, another indicator, long-term indicator. seem to be showing some promise. In 1995, we had about almost 1/3 of the Sri Lankan population is at poverty level. So now we are basically come to the opposite end of the thing, but we still have old figures, 2016. Some new figures have to be, it's not done regularly. This is inflation. As you can see here, the point here is that's the average inflation for, okay. So what we see here is the inflation is standing below 6%. Inflation is standing below 6%. This is another indicator of inflation, National Consumer Price Index, which is country-wide, whereas this one is Colombo-wide. So national index, as you could see here, it is showing some sign of rising in the 2019 and here too. Now this is another index that is being commonly used, Producers Price Index. Producers Price Index is a cost of production index. So as you could see here, cost of production seem to be going up. Cost of production index. So there is, it's not rising rapidly, but nor is it falling. Now this is the other export sector. As you could see here, the annual exports, it's only having 2019 figures. So exports are doing increasing, but not enough. So we will have a major challenge if we don't address this. Then this is the imports. So in the case of Sri Lanka has adopted a more controlled policy of imports. So therefore, at the moment we are having import controls very rapidly. As you can see here, import controls are very much relevant, possible here. Then the trade balance. Now this is where Sri Lanka should be expected to do improvements. So at the moment, the trade balance is precariously around 10% or more than 10%. So that's not a great scenario. Then the tourism is another sector that is basically a drag on us. And so that's for sure for some time. Then the worker remittances have dipped. So here worker remittances, why does it matter? When people send money, more money, our balance of payment problems are less and less. And so spending around 6.7 billion is the 2019 figure. So which is also showing a kind of a decline trend. So if this is continuously going, Sri Lankan options for making a case is going to be very poor. As you can see here, longer the poll, so current account balance has been always negative. This negativity reduces if we have more exports and the and reduction of imports. This is another area that we try to sort out when we have a 11 billion gap. We try to have more exports to reduce this, plus FDI, plus various other things. So 11 billion. So more, one thing the foreign direct investments would do immediately is it brings cash to the country without a direct commitment. So that as a result, you find that foreign direct investments are helpful to a country apart from its own. So this is the balance of payment overall scenario. This is what I was trying to tell you about reserves. Now, there were two reserves. One is bank reserves. This is the country reserves. The country reserves is you try to set aside a certain amount of dollars for as a backup. Now, normally the setup the amount of dollars that you set aside should cover certain months of imports. So at the moment we are covering about 6 months of imports. So therefore, we are not in a bad shape. But look at this, 2017, we had a massive drop in the official reserves. Then it's crucial that you maintain a country maintains its exchange rate in a prudent manner. But what happens here is exchange rate movements have been, Sri Lankan rupee had been depreciating quite significantly, and as you can see here, this happened in 2018. So like that, you find that this is the government revenue. Major concern is government revenue has been falling and falling again. This is the post-COVID, which we don't have at the moment fully, but fiscal policy is falling. This is within the expenditure. You have two sides. One is called day-to-day expenses or current account. The other is called capital spending. Capital means you are trying to settle loans or you're trying to borrow money to put up roads, infrastructure, etc. Whereas government expenditure is very much on consumables, salaries, and all that. Now, as you can see here, budget deficit a benchmark we have not arrived. So you can see here 7%, and then so like that you have sort of got. So here, some argue budget deficit cannot be kept at over 5% of GDP. So that argument is also prevailing. Now, this is the other irony of the Sri Lankan situation. 2012 onwards, the debt stock went up. So that's a pretty ironic scenario. Government debt has been going up. Now here, I will take you to here, this one. Now, as you can see here, credit to the private sector is also a good indicator if the economy is doing well. If the credit to the private sector is going down, and as you can see here, in 2016, it went down. So it went down means economic activity has been slowing down dramatically. This is how much government has been borrowing. As you can see, government here, this one refers to money creation. So there is quite a bit of spikes here with money creation. And so this is not so important. Net foreign assets, policy interest rates. This is, as you could see here, policy interest rates went up during the last regime. Now they are trying to bring it down. Why? Because the policy interest rates can help people to have less cost of finance and promote more investment, but it doesn't guarantee. Right. Okay. So then this is not important. Now this is another interesting thing about the economy, what we call non-performing loans and the banking sector. That means banks are unable to recover the money. Now, if you look at it, it has escalated quite rapidly in 2014, 15, and 19. Of course, 2020 is an exceptional year, but this rise is particularly intriguing. Why the non-performing loans in the banking sector is visible so much growing up? One reason is cost of finance has gone up, economy is not doing well, so people have not been investing. So these are some of the characteristics. So these are not important. Now I'm going to take you to this is the stock market. I'm not very interested. Now this is the area important. Challenges ahead. We have debt issues. We have import controls. We have political developments that can result in it, and we'll have a problem of keeping the balance of budget deficit under control because there were so many pressures. So like that, you can read this part. Then this is some of the medium and short term perspective, and hopefully if this works, it might help the other players as well. Now this is another area I thought I will end here. Most recently, Moody downgrades Sri Lankan rating, which means Sri Lanka will have to incur higher interest rates to borrow in the global markets, which is not a great scenario, and even whatever the investments in Sri Lanka might move out. So Moody's position is they have apparently looked at the values, etc., and so, but then central bank was quite angry about it, and they said that this was a reckless act, and they gave some of the explanations. And also there was another one, the speculation was the central bank Sri Lanka might default 1 billion. That never happened, so that's another positive one. Now this is the Moody's downgrading. Now this is the response. Central bank said, look, what they did was not right. Now this is the first one. They were talking about the stock market. They say stock market has been rising in the 20th time, and that should have been considered. Then also they were talking about, okay, Sri Lanka has recovered from COVID, and that's another factor under the current circumstances. Then this is an interesting chart, which the red color one showing light rise in the exports over the middle of the year, and that's a major thing because we never had imports, exports becoming higher than the imports. Now here we were able to have a certain amount of surplus. Now this is the trade deficit. As you could see here, trade deficit has been quite high, and so as you can see here, 2019, the 2020 trade deficit was going down. Trade deficit was going down, so which means Sri Lankan economy is not overspending. But the downside is there are a lot of import controls affecting thousands of people. I happened to be at a function yesterday, and I was talking to one of the major car importers, a traditional company, and the chairman, he was telling me that they will not be able to function because of import controls. But on the other side of it is, government position is import controls are necessary because of unnecessary and excessive imports that had taken place. So who is right, who is wrong, will only history will tell us. Right. Okay. So at the end of the day, what is important here is US dollar 5.8 billion. Okay. So current Sri Lankan trade deficit has almost come to about 6%, 6 billion, as from 8 billion in 2019. Now, this is this tourist arrival is still a major problem. So here we can see there are some imports from current consumers, computer services. So this is worker remittances. As you could see here, worker remittances have outperformed the last year, which is good. Foreign direct investments have not been where they are supposed to be, and so here foreign direct investments have not been. By the way, 2017 and 18 they have been quite a large for foreign direct. Stock market performance is being highlighted as a major outcome, but the problem with stock market is stock market should perform well only if firms are performing well. At the moment, not many firms are doing well in the so therefore what could happen is maybe many people borrowing from commercial banks and buying stocks, assuming that the stocks are. So it's a more of a speculative thing at the moment. So these are some of the production data. So they do seem to show the recovery phase of everything. This is the exchange rate. Right. Okay. So that's where we come to the. Right. Now this is also an interesting chart, as you could see here. This is the net foreign holding of treasury bills or bonds. Now what you see here is it has been a decline, steady decline. So I was telling you about official reserves. Official reserves have improved to 7.4%. So this is this is what I finish the discussion now. We can take up a few questions if you like. Okay. Are there any questions? Please ask. So sounds like no questions. So then we'll wind up the session now, and hopefully you all were able to gather something and get the benefit of the discussion. And it's not the best time to have a discussion, online discussion. I find rather little depressing and problematic, but nevertheless, I hope we were able to manage what we want to achieve. Okay, So good luck, and I'll go off now.
Thank you, sir.